Vici has an incredible past performance. It has raised its dividend every year while targeting a 75% AFO payout ratio, which is very solid for a company. It has a 5.3% dividend yield right now, and as you can see, the compound annualized dividend growth rate has been 7.6%, which is extremely above the other peers in its industry. And with a possible great 2024 ahead, should this be the time to invest in Vici? Well, why do I say that it will be a great 2024? Well, potentially the Fed will be decreasing interest rates in 2024, and in this scenario, real estate should outperform the broader market, since with cheaper interest rates, there will be more acquisitions that will take place. But why will this environment especially benefit Vici? Well, this is because it has very unique landmarks, such as Caesar's Palace that you're seeing right here in Las Vegas. And this is the inside of the building. Why do I say unique? Well, most REITs usually focus on either commercial buildings or residential buildings, which are more homogeneous and are more similar between one another. However, for Caesar's Palace, it's so unique, it's so well themed that probably Caesar's Palace will not be able to move out of this building ever if they want to continue operating. So it is basically the definition of a monopoly. And what they say in their annual reports is that they are in the business of owning and acquiring gaming, hospitality, and entertainment destinations subject to long-term triple net leases. Well, this means that the tenant, or for example in this case Caesar's Palace, will pay a bit or the majority of the property tax, the insurance, and even common area expenses, which is a lot less things that Vici has to worry about when renting these huge buildings. Additionally, they have a leading portfolio of high-quality experiential gaming, hospitality, entertainment, and leisure assets. As you can see, they are very unique and focused and themed to what they are, so the tenant is very hard that they will move to a different location. Then the properties also feature diversified sources of revenue on both of a business and geographic basis, meaning that the majority of them also have like restaurants apart from their main operating industry. In terms of the long-term lease agreements, they provide a highly predictable base level of rent with embedded growth, and in this channel, we're all about predictability. So this is just their portfolio of real estate. They have 54 gaming and 34 non-gaming experiential properties. Here are the majority or their biggest landmarks in terms of what they own in real estate, and they of course have the different Caesars. They have some Hard Rocks, MGM buildings, which are all amazing to have in their portfolio. And as you can see, these are the acquisitions that they have recently made in 2023, the Bolero portfolios, which are an ownership in experiential non-gaming real estate, since it's bowling alleys. And then they also have loans into experiential non-gaming real estate, such as Chelsea Piers, Great Wolf Lodge, Canyon Ranch, or even Cabot. And this is great because it shows how they are moving away from gaming into diversify also their different sources of revenue. Their financial analysis using 2022 numbers looks very solid. However, I'm not sure about two of these values. Starting with the margins, they look very solid. 70% profit margin and 62% operating margin look very good, with a very high cash conversion, meaning that they can convert their income into free cash flow extremely well and pay out a nice dividend. In terms of interest coverage ratio, they can only cover their interest 3 times based on their EBITDA. And I would not worry too much about this, since their income is very recurrent, since they have very few buildings with very high payouts and very stable income. However, I would like to see this number be a bit higher because they have recently increased their liability by a lot, and I would like to see them bring this down. And in terms of return on capital employed, it's very low, sitting at a 4%. However, I don't know if you should even use this number to analyze rates. In terms of financial analysis 2023, you can see that their revenue, gross profit, net income, and basically everything is up in terms of a trailing 12 months basis, and see that their margins have been stable or even the net margin increasing a bit. In terms of fundamental analysis, I give them a 7 out of 8. The only thing that worries me is the liability risk. Because of what I told you, I would like to see them make an effort of paying down the debt, which I have not seen. But regardless, they have an incredibly solid balance sheet. They have insane cash flow consistency, pays out a big dividend, which is also nice for those of you who are looking for that. And this is where it gets interesting because they have a huge existing moat and competitive advantage. I would consider this company basically a monopoly, which makes them have very high pricing power. And why is this? Well, this is because of what I told you, that their buildings are unique. Caesar's Palace does not exist without their building that they're in. and any other casino that they have in the Las Vegas strips or all around the US, they do not exist without their buildings. Why is this? Because they are extremely themed and no other competitor can just come out of nowhere, build a skyscraper in Las Vegas with the same theme as Caesar's Palace just to try and outbid them. So that is wonderful for a company like this. And apart from that, they also have organic free cash flow and revenue growth. In terms of valuation, they are currently trading at a big discount comparison to what their PE ratio has been in the past 3 years. They are sitting currently at a PE ratio of just under 15. Their free cash flow yield also shows them to be at an attractive pricing range right now, with it almost being 6%, which is almost double of the long-term inflation rate. And in terms of risks and possible challenges, I see this company being having an extremely safe and sound 2024. Why is this? Well, firstly, they don't have any big competitors. As I said, for me, this is virtually a monopoly. I don't see their competitive landscape worsening. In terms of regulatory changes, I don't see them being heavily affected by them. I did put a 40% to be conservative with the analysis. The only shock that they could face, I could see being with regulations affecting the gaming industry, since they are extremely dependent on revenues from the gaming industry. However, I don't see that there will be any major changes to Las Vegas. I think this is a cash cow for the US as general. With a new bubble or sphere that has just opened up, I think this is a good sign that Las Vegas will be around for a lot longer and gaming is here to stay. In terms of performance as well, I don't see any risk. I did put a 40% to be conservative. I would actually lower this down to a 20% because, as we have seen, their revenues are extremely consistent, super resilient, and of course, their tenants have to pay them in order to keep operating. If they do not pay rent, they will not be able to operate and make money. So this is a very good business in that terms of aspects. And in terms of market, this is the one that worries me the most. However, it does not actually worry me at all. I don't see it happening. But in case that there is an economic downturn or a type of cyclicality risk that affects tourism around the US, this will heavily impact Vici because its tenants, casinos or hospitality businesses, will come back to it and ask for lower prices, which Vici in some cases will have to accept. However, I'm not worried by this at all. And in terms of the investment conclusion, before we move on, I do have to say that I'm not a financial advisor. This is not financial advice. Please make your due diligence before actually buying or investing in Vici. The moat, I think this company is the definition of a company with a moat or with a monopoly power. It has a great competitive advantage, and just think about it. All the clients it has are fully recurrent. They don't have to be looking for other clients, and there is no risk, or essentially no risk, of their clients looking into competitors. They have incredibly consistent cash flows, which is amazing to see, and this allows them to pay a very big dividend and increase it year after year. However, I don't like the fact that they don't have a high return on capital employed, but I would not give it such big importance because we don't even know if this is the proper metric used to value a rate. So I would say that this is potentially a good company which may generate high returns, but has a low return on capital employed. Just the only thing you should consider. So thank you for watching. As always, this has been the Cash Flow Compounder. Join the free Patreon for extra content, and there's a link in bio for a free stock if you join Trade Republic or Trading 212.